Good afternoon, everyone. Welcome to our Research and Development Tax Credit for Software Development webinar. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Now, I'm going to introduce our presenters. Michael Maroney is the Senior Manager with KBKG and advises clients on tax matters related to federal and state research and development tax incentives. He has 20 years of experience working on tax reviews ranging from sophisticated multi-year claims to short-term consulting projects. He has advised hundreds of clients across a variety of industries, including aerospace and defense, manufacturing, agriculture, pharmaceutical, communications, industrial products, consumer goods, software technology, and energy. Chuck Huey is a senior manager with KBKG and leads the Southeast Research and Development Tax Credit Services Group. He has 10 plus years experience helping companies identify, calculate, document, and defend federal and state R&D tax credits. He has advised clients of all sizes, from startups to Fortune 500 companies. Chuck's experience spans across various industries that include automotive, manufacturing, pharmaceutical, software development, chemicals, food and beverage, defense, aerospace, cosmetics, gaming, and many others. I'd like to now turn the presentation over to our speakers.
Great, thanks, Diana. This is Michael Maroney, and I'd like to welcome everybody to our one of our industry-specific R&D credit webinars for the software industry. We also have done industry webinars for other industries, including food and beverage and life sciences as well. For those of you that are interested in a general and sometimes a more deeper dive into the R&D credit, the way that it's calculated and some of the issues surrounding the R&D credit in general, we do offer an R&D 101 course that you can find on our website as well. So with that, I'd like to talk a little bit about the agenda that we're going to be covering, items we're going to be covering today. So we're going to start with an overview of the software industry, recognizing that most of our participants on the call are probably CPAs from CPA firms or those that are CFOs in the industry. So we want to make sure that we're all kind of familiar with the terms that we're using and the qualified activities as they relate to software. Then we're going to talk a little bit about the R&D tax credit overview, which again, it's a high level on the R&D credit. And then we're going to talk about maximizing value specifically for the software industry. And then we're going to conclude with talking about other considerations, including some IRS audit considerations. And as Diana mentioned, please feel free to ask any question that you have in the question box, and we will try to cover those during your time when you're answering the polling questions. We will try to address the chat questions then. So with that, I'd like to, let's go ahead and advance the slide, and we will talk about the overview of the software industry. So these are, this is by no means all-inclusive, but this covers most of the software development space. And so I'd like to just kind of talk briefly a little bit about each one of these. So with web development, what that kind of entails is, web development, it's more than just developing or designing a website and getting it up and running and putting, it may have been that way 20 years ago or 25 years ago now. But today, when you go onto a website and you're interacting with it, there is so much software development that takes place behind what it is that you're doing, so that when you click on a button and it maybe launches what seems to be a native application, It makes it feel that way because of the software development that's being done to that. It's not a native application to that website, but it seems to feel that way. And so, just want to bring that to your attention that a lot of the web development that's being done is not just simple website design that you can right out of a box configure for your business. And then do that. This is web development has become so much more than that. The next one is mobile development, and this is probably didn't exist 15 years ago, but with the explosion of all of the smartphones and the tablets, there's an app for everything, and so there seems to be a never-ending stream of software programming going on to develop the next great app, whether it's a game or whether it's a tool that you use. And so mobile development is another big area. Data science is an interesting field of software development because, as scientists conduct their research, they need data to be analyzed very quickly and very efficiently. And so there is this whole part of the software development that is focused on creating that type of programming. Okay, things like machine learning is one example I can think of, where you need in order for the machine to learn what it needs to know in order to make its own decisions, there has to be a large amount of data for it to consider, and it requires software programming to make that communication happen and make that data appear in a way that the machine understands. The next one is application development. So these are when you think of application development, think of the old school programs like Microsoft Word, for instance. That's an application that is run on. It used to be run on your desktop. It came in a disk. You load the disk up, and you go through about 15 minutes of setup, and that's the application here. Now these applications have evolved since then to where they're now able to be web-based, where you're running it off of remotely off of a server that's out in Arizona somewhere. But that's application development. It's a specific application that's being developed for a particular purpose. Then there's back-end development, and what these are programs that where the development goes on behind the scenes. So you've got your front-end program that seems to be what it is that you're running and you're doing, but there's a bunch of development that's happening or that happens behind the scenes in order to make that work. And so that could be operating system development. But it can be so much more than that as well. Sometimes it often involves servers, for instance, like Linux servers being scheduled for tasks that they have to perform, and that development happens behind the scenes. You don't see that happening at the front end. So then the next one is software tools development, and this is probably best described as software development that is done specifically for software developers. So if you're a software programmer and you're wanting to create a program for use, these are the tools that you would use. And so there's this whole section of software development dedicated just to developing the tools that software developers need in order to create the next program that they're working on. The next one is API development. This is called API stands for Application Programming Interface, and what this involves is developers that are programming software for across different operating systems. So if you need to be able to communicate between various platforms, various programs, various operating systems, and they're the ones who build the communication structure to make that happen. I'm not going to go through all of these. I just want to touch on a couple more. The security software development, as as cybercrime becomes more and more prevalent and more far-reaching, there's always going to be a demand for increased security, software security. So there's programming involved with that. With cloud computing, as more and more companies move stuff off of an internal server, within the four walls of their building, and require more flexibility with regards to applications that they want access to, or just the sheer volume of data that they have to maintain and analyze. That's being housed in these server warehouses, off-site. And so there's a whole, being able to quickly retrieve that information and present it in such a way that it seems seamless, like it's happening right there off the website, for instance. That's a good one as well. And then finally, video game development. So back to that might go hand in hand sometimes with mobile development, but it seems like everyone's playing on their phones now and their tablets. But even video game consoles like the PlayStation and so forth, they have a whole industry, huge industry on just creating the next great video game. So I go through that list there, and I know that took a few minutes, but hopefully what that gets you thinking about is what type of software development that you are involved with, and for the CPAs on the line, what type of software development your clients are involved with. Because each of what I just said, all of these areas of software development can qualify for the R&D credit. And so with that, I'm going to advance to the next slide. Let's look a little bit here at the overview of the software industry, the software development life cycle. You may have heard that term used before, where it's just the five major stages of software development. We're going to kind of walk through each of these. So the first one is the requirements analysis. And this is really arguably the most important stage in the development life cycle, because anything and everything that needs to happen in the programming, these are where things have to be communicated. So I've got it in italics there. Communication gaps could result in validation errors and bugs. So the more time that is spent up at the front end on the requirements and the analysis of the requirements can save a ton of time in the programming and testing. Then there's the design phase, and this is where the detailed functions and the operations of the software, the screen layouts, what business rules are defined, and the process diagrams are created. So this is where the programming of the software actually takes place. Then there's implementation, and this is where code is written for the various modules and various subsystems within a software platform. And this is also where unit and module testing is conducted. Then there's the testing, and the testing that involves unit testing, system testing, and then finally or ultimately user acceptance. So if you're creating the software for a particular customer, then that customer needs to test it and accept that the design has been validated. And then finally, there's evolution. Now, evolution can mean a couple of things. It can mean that you might be on your way to the next revision of the software. So, in other words, as your software gets released into the marketplace, then there's always feedback you're going to get. There's always going to be intended improvements, where as you get your feedback or as you test it yourself, you're like, what, we should have done this to it. We should have added that feature or that functionality. Or as technology just advances in the marketplace, there's going to be an opportunity to improve the software. And so evolution can mean that it's just the preparation, improvements made to the software for the next generation of that software. But it can also be, that as technology gets older, as the market changes, as the needs of companies change, that the software needs to be moved to where it kind of just becomes obsolete, and you're dissolving that particular software product. So it can mean both of those things. And it's in a circle because, as I said, once you get to the next revision or the next generation of the software, then you've got your requirements analysis and design again that you're constantly improving. So I want to, I've interspersed throughout this presentation some case studies here, just to kind of bring everything back to, the R&D credit and what types of companies can qualify for this and what the qualified projects could be. So in this one, we've got a data science software example. And so here we've got a Chicago-based software company that's created a new data science platform used by scientists, analysts, and engineers to prototype and build and deliver their specific software products. So in this example, I've got a 2010 company. It started in 2010. They currently, in 2017, have 23 engineers. They have a total wage amount of $3,500. I'm sorry, $3.5 million. Qualified wages of just over $2 million. Their taxable position is that they pay regular tax. And we'll talk about it a little bit later, but I want to introduce it in the example here. But the payroll tax credit, in this case, they would be ineligible for it because in this example, they would have had revenue for greater than 5 years. So they would just be able to offset regular tax with their R&D credit. So in 2017, their federal credit was $200,000, and the Illinois credit was $52,000. So just for that 1 year, they've got a total credits of $252,615. And of course, with the R&D credit, you can go back to any open tax year, and for federal, that's 3 years, and claim those credit on amended returns. So we could be looking at potentially triple this amount if they wanted to go back and claim the federal credit for prior years. Now, the qualified projects that this company worked on they programmed code to optimize communication over 20 different data storage systems. They designed a system enabling customers to detect fraud. And then also programmed applications so customers could import data and use various proprietary modules to analyze various data sets across multiple platforms and from various devices. So 3 simple, well, maybe not so simple, projects that they worked on, and they qualified. And so then the activities that the engineers did related to these qualified projects is where we get their qualified wage amount from. So I think I want to turn it over to Chuck now, who's going to talk a little bit about the R&D credit overview. Chuck?
Yeah, thanks, Michael. We'll go through the overview here of the R&D credit as well as touch on some of the benefits. The first thing is that the Section 41 credit for increasing research activities was originally enacted in 1981. At that time, it was a temporary code section and stayed that way until fairly recently with the PATH Act of 2015. The Section 41 credit's a federal statute. However, most states offer some form of R&D credit that borrows from the federal statute. There are billions of dollars worth of R&D credits claimed every year. I can't recall off the top of my head what the latest IRS statistics were on that, but $10 to $15 billion, somewhere in that range, I believe. But still, there's tons of credits that definitely go unclaimed. The credit's a general business credit, typically ranging from 6 to 10% of qualifying research expenditures. As such, it provides a dollar-for-dollar reduction in a taxpayer's income tax liability. Pass-through entities such as S corps and partnerships can also claim the credit. Benefits flow through to the individual shareholders on each shareholder's respective K-1s. The R&D credit can be claimed for all open tax years under statute, which is generally a 3-year look-back opportunity, but there's other reasons that the statute may remain open, such as for NOLs and AMT and a few other things. But unused credits can be carried back 1 year and forward for up to 20 years for federal purposes. clearly, there's other benefits listed there on the slides, increase in the return on investment, lowering the effective tax rate, improving earnings per share, etc. So, all right. On the next slide, I'll cover the four-part test, which is generally how R&D is defined by the IRS. Oftentimes when we have initial conversations with clients and CPA firms, people think about lab coats and beakers when they hear the words R&D tax credit. But in reality, the credit is much broader in application than that. And following if the following tests here listed on the screen are met, then you have an opportunity, or your client has an opportunity, to claim the credit. In order for activities to qualify for the research credit, the four tests listed here have to be met. These tests are applied at the business component level. It's important to note that a business component can be defined as a product, process, software, technique, invention, or formula. The first test is the permitted purpose test. This has to do with the objective behind the research. The objective must be to create new or improve existing functionality, performance, reliability, or quality in a new or existing business component. The second test is called the elimination of uncertainty test. At the outset of the project or the development activities, there must be some form of technical uncertainty related to either the appropriate design of the business component or the capability or methodology for improving the business component. The third test is the process of experimentation test, which works in conjunction with the elimination of uncertainty test. Because you have uncertainty, you have to go through this process of experimentation to eliminate that uncertainty. This requires that substantially all the activities constitute a process of experimentation, which is defined as the evaluation of different alternatives. And again, it's to eliminate the technical uncertainty that existed at the outset of the development activities. Lastly, the fourth test is called technological in nature test. After all, this is the R&D tax credit. So projects or development of business components has to fundamentally rely on hard sciences such as engineering disciplines, physical, biological, computer science, etc. So this next slide just takes that four-part test and applies it specifically to software development. In terms of the permitted purpose, some examples would be creating new modules, adding new features, improving performance of existing software, increasing speed, improving stability, etc. In terms of technical uncertainty, some questions that might exist in the beginning of the development activities might be, what is the appropriate technology to use? What is the optimal system performance? What impact does combining different systems or modules have on the software in its entirety? You may have multiple modules that work fine by themselves, but when you put them all together, then things go awry. So that could be the case as well. Again, because this technical uncertainty exists, software developers have to go through a process of experimentation, which can involve various design considerations, such as alternative system designs, as well as different forms of testing, such as functional testing, regression testing, etc. And then, lastly, software development, clearly involves computer science and software engineering, so it covers that fourth box. I'll now touch on internal use software and specifically the final regulations that came out in October of 2016. At that time, the IRS issued guidance on the qualification of internal use software, or IUS, for purposes of the Section 41 credit for increasing research activities. The final regulations address many of the comments that were received regarding the proposed regulations that came out in January of 2015. The first thing is, what is internal use software? It's software that is developed by or for the taxpayer, primarily for use in general and administrative functions that facilitate or support the conduct of the taxpayer's trade or business. G&A functions are limited to financial management functions, human resource management functions, and support services. Whether the software is deemed IUS or non-IUS depends on the intent of the taxpayer and the facts and circumstances that exist at the beginning of the development activities. The definition of software that is not for internal use is software that is developed to be commercially sold, leased, licensed, or otherwise marketed to third parties. Software that is developed with the intention of allowing taxpayers to interact with third parties, or that allow those third parties to initiate functions or review data on a taxpayer's system, or would not be considered developed for internal use either. Connectivity software, also referred to as bridging software, integration software, middleware, etc., allows multiple processes running on one or more machines to interact across a network. This software should be specifically identified or categorized differently from other types of software. Whether it's considered IUS depends on the function the software provides rather than on the type of software that we're talking about. Dual function software, is another thing that was touched on and clarified in those final regulations. It's G&A software that allows interaction with third parties. This designation allows the taxpayer to identify a subset of the software development activities that allow that interaction with a third party, even though it was intended for use in G&A functions. There's a software designation related to this component. A taxpayer may include 25% of the qualified research expenses of the dual function software in computing the amount of the taxpayer's credit if the activities constitute qualified research and the use of the dual function software by third parties or by the taxpayer to interact with third parties is reasonably anticipated to constitute at least 10% of the dual function software's use. In this case, a third party means any corporation, trade or business, or other person that is not treated as a single taxpayer with a taxpayer pursuant to Section 41F. IUS can still qualify for the research credit if an additional set of criteria are met, in addition to the four-part test that we covered previously. It's often referred to as a three-part test. Number one, the software has to be innovative, meaning if the development is or would have been successful, the result would have been a substantial and economically significant reduction in cost or improvement in other performance metrics. Number two, there has to be significant economic risk. If the taxpayer commits substantial resources to the development and due to technical risk, there's substantial uncertainty whether those resources would be recovered within a reasonable period, then the taxpayer meets this test. It's important to note here that for these purposes, substantial uncertainty relates to the capability or methodology of achieving the intended result. And number three, the software is not commercially available, so that the taxpayer cannot purchase, lease, or license software without substantial modification and expense to that software. And lastly, on this particular slide, it's important to note that the final regulations are prospective in nature and apply to taxable years beginning on or after 10/4/2016. The IRS will not challenge return positions that are consistent with the final regulations for any taxable year that ends on or after January 20, 2015. I'll now go through a brief internal use software example here. In this one, a Salt Lake City-based company created a new billing system to replace its legacy system. The new system would automate several manual functions. Although it would have some client-facing features, it was primarily intended for internal use. Operations started in 2004. There were 4 software engineers. Employee wages totaled $4.6 million. The qualified wages were $200,000. The taxpayer pays regular tax. In this instance, as was the case with the example that Michael touched on earlier, there's no payroll tax credit opportunity, and again, I'll explain this in a few slides. The taxpayer here ultimately received a total of $40,000 in federal and state credits for 2017. The qualifying activity related to programmed modules that allowed improved customer and vendor access to data within the company's database. Note that since this was dual-use software, only the portion of the development activities dedicated to the client-facing features and functionality were captured as qualified expenses. With that, I'll turn things back over to Michael.
Great, thanks, Chuck. So let's change our focus a little bit now. We're going to talk a little bit more about qualified software activities. So, when you've got a company that's developing or improving technologies that they currently have, that can be a qualified activity. Also, those that are designing and developing software architecture for the software itself. Those that are establishing functional relationships between software modules. So if you've got 2 different modules and they need to talk to each other, they need to share information, they need to share data, they need to if one needs to analyze the data from the other 2, those relationships have to be established by software programmers. Now, also programming and testing software source code is also a qualified activity. Conducting testing on the unit, integration testing, functional testing, performance testing, and regression testing all qualifies for the R&D credit. Developing any new or improved feature enhancements to a software program can qualify as well. Conducting analysis for new functional software end requirements, domain software elements, or scope analysis for new functional software enhancements also qualifies. And evaluating and establishing functional specifications or requirements at the outset of the project can also qualify. And these are just a few of the qualified activities. There are many more. Let's spend a little bit of time talking about non-qualified activities. So once a software design has been validated and released, the version has been released into the public, or the design's been validated and it's been commercially released. Then there's oftentimes maintenance of the existing software application or products, and that maintenance typically does not qualify as research and development. Also, simply configuring a software application to meet a specific company requirement or customizing that particular software application for that company's business oftentimes does not qualify either. Reverse engineering is something that clearly does not qualify. If you take somebody else's software program and try to deconstruct that to see how everything kind of fits together, maybe with the intent of developing that in-house or for your own purposes, that does not qualify. Performing studies or activities to select vendor products does not qualify. So, doing price comparisons or even spec comparisons to determine whether a certain vendor's product will meet your needs is not going to qualify. Detecting flaws and bugs in software. That's something that's specifically non-qualified in the regulations. So any type of bug fixing. Now it's interesting when you talk to software engineers. You add up enough of those bug fixes, and it ends up being a new revision to the software that ends up in the next generation software. So when you're talking about bugs, these are simple flaws in the software that need to be fixed. Think of the software almost as broken, and you're just fixing what should have been originally working. And so just regular repairs or bug fixing does not qualify. The next one is modifying an existing software to make use of new or existing standards or devices, or to be compliant with another vendor's product or platform. In other words, if you're simply modifying a software to use a new technology or a new programming language to make it compliant with whatever's the standard is in the industry, that's not going to qualify as R&D. Developing software that is substantially similar to existing software. Again, I kind of make that akin to almost reverse engineering, where you're just duplicating an existing what exists already, is not going to qualify. And then upgrading to newer versions of hardware or software, or installing vendor fix releases. That's not considered R&D either. I'm not going to go through all these. We got another slide that has some more examples on it, just in the interest of time. So data quality, data cleansing, and data consistency activities, that's not really considered R&D because you're not really improving the function, performance, reliability, or quality of the software itself from a functional or a performance standpoint. Bundling existing individual software products into product suites is not R&D. In that instance, the vast majority of the R&D happened inside those individual software products, and simply integrating them all together into a product suite. It's a hard case to be made that there's a lot of R&D in that. And then expanding product lines by purchasing other products. Just adding to your existing product line by purchasing products is not R&D. All right, so I think I want to turn it back over to Chuck now. He's going to talk a little bit about who qualifies for the credit and what expenses can be attributed towards the credit as well. Chuck?
Thanks, Michael. So like Michael just said, we've touched on the qualified activities. So now let's talk about who qualifies. Basically, it's any employee who performs qualified activities. So some examples would be concept development, gathering requirements, defining specifications, programming for prototype platforms, systems, modules, applications, etc. As well as the QA testing to ensure that requirements are met. Next, it would be any employees who perform direct supervision of other employees who perform the qualified activities. So supervisors, managers, directors, VPs, who directly supervise the qualified activity of their subordinates. This may include things like reviewing and approving system designs, communicating technical requirements, supervising software testing, and participating in technical meetings. Lastly, from an employee standpoint, employees who provide direct support to other employees who are performing the qualified activities. So this would be things like documenting test results, maintaining dedicated test networks, creating experimental models, etc. From a non-employee perspective, you can also include typically 65% of amounts paid or incurred to outside contract service providers when they are performing qualified research on your behalf. note that the qualified activities must be physically performed in the United States. Activities physically conducted outside the U.S. are not eligible for the R&D credit, regardless of the type of activity that's being performed. This applies both to the employee as well as the third parties. All right, next we'll talk about the expenses that are eligible for the credit. To the extent that a project meets all four parts of the four-part test that we discussed, and we're able to capture expenses associated with the project towards the research credit. There are four types of expenses which qualify. These are wages, supplies, contract research, and computer rents and leases. Qualified wages are generally defined as the qualified portion of an employee's W-2 Box 1 wage amount. You're not allowed to include the pre-tax benefits and wages used for calculating the work opportunity credit. Qualified supplies are items that are used or consumed in the research process. For example, materials used in prototypes. Supplies cannot be capital in nature, therefore taxpayers cannot qualify land, machinery, equipment, etc. Additionally, general and administrative expenses such as travel, meals, entertainment, and telephone expenses cannot be captured as qualified supplies. Due to those things, supply costs don't typically apply to the software industry. Thirdly, as we discussed, the qualified contract research expenses are 65% of the amounts paid to third parties for purposes of qualifying research. In order for these payments to qualify, payment cannot be contingent upon the success of the research, and therefore qualified contractors are paid regardless of whether or not they are successful. The taxpayer must also retain rights to the research. Lastly, cloud computing costs can qualify for the credit. These would be costs paid for cloud computing space to vendors such as Amazon Web Services or Rackspace in order for the taxpayer to conduct their development activities. The PATH Act made three important changes to the R&D credit. First and foremost, the R&D credit is now permanent, so that's good news for us and taxpayers as well. The second big change is that the R&D credit can now be used to offset a portion of payroll taxes for qualified small businesses. And the other key item in the PATH Act was that qualified businesses can now use the R&D credit to offset alternative minimum tax. Regarding the payroll tax offset, it allows qualified startup businesses to claim up to $250,000 of the R&D tax credit against their payroll taxes. A qualified startup is defined as a company with less than $5 million in gross receipts for the current tax year and no gross receipts for any tax year preceding the 5 tax year period ending with the tax year. So, if the first year of election is 2017, then the taxpayer must have had no gross receipts in a tax year preceding 2013. You cannot make the payroll offset election for more than 5 years. Gross receipts are not required, so companies with no gross receipts can make the election and use the credit. C Corps may apply R&D credits carried forward towards the payroll tax. So, obviously, this is a great opportunity for software companies in the startup phase. Regarding the AMT offset, prior to the PATH Act, taxpayers in AMT could not use the R&D credit to offset AMT, but now eligible small businesses can use the credit to offset AMT for tax years beginning after 12/31/15. An eligible small business is defined as a non-publicly traded company having an average of $50 million or less in gross receipts for the prior 3 tax years. This provision is similar to the AMT relief opportunity that existed back in 2010. Unused credits can be carried back or forward. As a reminder, with the latest in tax reform, corporate AMT was repealed and the individual exemption amounts were increased for tax years beginning after December 31, 2017. I'll now walk through a payroll tax offset example. This is an example of how payroll tax election can help a qualified small business. In this example, a software developer began operations in 2016. The company is comprised of 15 individuals and is not expecting any gross receipts until 2018. In 2017, the company had 0 gross receipts, qualified wages of $2 million, resulting R&D credits of $200,000, and a payroll tax liability of $125,000. This company filed their 2017 tax return in March of 2018. Prior to the PATH Act, this taxpayer could have claimed the research credit, but would not have been able to use any of the credits until they had taxable income. So due to the PATH Act, they were able to offset the qualified portion of their payroll taxes in the second quarter. The unused credits were carried forward. I'll walk through a couple more examples. This one involves a gaming software company. Atlanta-based software company created new gaming software for the Pokemon video game series. They started operations in 2012, had 23 software engineers, $1.4 million in employee wages, $800,000 in qualified wages, paid regular tax. Due to their circumstances, their payroll tax credit eligible. The resulting federal and Georgia R&D credits totaled about $135,000, and they were able to offset their payroll tax with the R&D credits. Some examples of the qualified projects that led to these credits were programming software to animate their gaming assets, designing and coding custom 3D graphics and animation, as well as sound effects. They designed a proprietary motion capture software for realistic game character animation, and they developed a game networking architecture for multiplayer online games. The next example involves software as a service. An Indianapolis-based software company developed a new cloud-based enterprise resource planning software, which it licensed to customers on a subscription basis. Started operations in 2006, so that tells us that they're not payroll tax credit eligible, assuming they had those gross receipts dating back that long. 12 software engineers involved here, $2.5 million in employee wages, roughly $1 million in qualified wages, paying regular tax, and resulted in $177,000 in combined federal and state credits. The qualified activities here related to programming code to add new search functions, improving the speed for data retrieval and generation of customizable reports. They also developed new application controls to improve data security and designed a new user-friendly mobile app for access via tablets or smartphones.
For purposes of the R&D AMT offset, this is just an example. So in 2017, a company generated R&D tax credits of $331,000 and had a total tax liability of $219,000, of which $188,000 was regular tax and $31,000 was AMT. So under the old rules before the PATH Act, the entire R&D credit could not have been utilized and would have had to have been carried forward. But since the PATH Act, now they can utilize up to $178,000 of that credit to offset alternative minimum tax. Let's see. For this slide, I think I'm going to skip this slide. Just refer to it in your download off of our resources page. But this is some specific software development examples that can qualify, and then that's a case study and case study. All right. So I want to turn this over to Chuck real quick to talk about maximizing the additional benefits. And Chuck, if you could just pick 2 or 3 of these, as some that maybe we haven't talked about yet, that can be a really additional benefit here for the participants.
Absolutely. Yeah, I think the ones that I'll touch on relate to the high level executives, probably the job titles one, and employees outside of the core software development departments are probably some key ones here. The high level executives often get overlooked, but if they're directly involved in performing research, which is common especially in smaller organizations, or if they are directly supervising those who are performing qualified research, they should be included in the credit calculation, along with the core group of software engineers. And then with the job titles and the employees outside of the core software development departments, oftentimes employees get excluded from the analysis, just due to their job title. But oftentimes the job titles are, inaccurate, meaningless to some companies, or not all encompassing, and employees fall outside of that core development group and just don't get a look, basically. So normally there is some level of opportunity outside of the core development group. Just take sales employees, generally speaking. Oftentimes they're talking to customers and get input, and they take that input, and that becomes part of the design requirements to the software, which that is the beginning of the development process, is determining what those design requirements need to be. So that's just a few brief examples there of opportunities to add benefit to your software development credit calculation. Michael, I'll kick it back over to you.
Great, thanks, Chuck. Let's talk real briefly about some IRS audit considerations. Number one, we talked about internal use software. They do look at that, so we want to make sure that you're following the rules with regards to internal use software. The second item is funded research. So this is research that is, if a customer comes to you and asks you to develop something for them and they're paying you, you want to make sure that you are at financial risk of failure for that development. Usually that means that your customer contracts are under fixed fee terms. But also you as the taxpayer want to retain substantial rights to the technology that's under development, which means that there's no restriction placed on you using that same technology for another customer. Foreign activities. You do not want to include any foreign activities. So where the research is being performed is key, and it has to take place in the United States. And then finally, contemporaneous documentation. And that kind of leads into the last slide here, so I want to just kind of go through that real quickly, is that these are like the 7 major steps of the development process, with some of the examples of the contemporaneous documentation that we typically ask for in the course of doing a study to substantiate the R&D credit. And so, the closer that you can create a nexus between the activities that are being conducted and the people conducting them, as well as the expenses that are being spent, then you fare much better under audit. And thank you everybody for joining, and we look forward to seeing you on our next webinar. Thank you.